Hello everyone. Welcome to this webinar on salary structuring with special emphasis placed on managing and implementing a flexible benefits plan. Let me introduce myself. I am Samira, co-founder of Paybooks, and I will be taking this session on learning some fundamentals on compensation structuring with FBP. All of us know how important compensation is for any entity. Research has consistently shown that compensation is one of the top reasons why employees join and leave the companies, and hence it is important for all of us to know more on how to have the best or the optimum compensation structures in our companies. So just to remind you, this would be a 1.5 hour session with the last 30 minutes being set apart for taking the questions from all of you. I will try to answer any question on specifics of salary structuring, the tax impact of the same, and if you have any questions, say on the legal implications on the labor laws, I can handle those. Also, if from the employee side you have some questions, I will be glad to take them as well. You can see a chat window to the right of your screen. Please use that window to type your questions as they arise in your mind. But I will be answering all the questions in one shot at the end of the session. We will have the recorded version of this webinar on our website in a few days, and you are free to refer the same and come back with further or some follow-up questions. So most of the attendees of this webinar are from the HR or the finance departments, and so already have implemented some salary structures in their companies and also understand the basics of structuring. So a natural question would be, what is the need for this specific webinar? For the advanced users, this webinar will be a good brush up of the key concepts and maybe probe them to think beyond just tax saving as the ultimate objective of structuring. As we go along in this session, we will see there are many considerations beyond tax optimization, and for the users who wish to bring in some or improvise their compensation plans to take it to the next levels so that the plans are more employee friendly, this webinar will suggest some ideas and some ideas around FBP. And lastly, for the fresh CEOs and entrepreneurs, this will be a good base to understand the key concepts in and around the structuring. So at the end of this webinar, all of you should be hopefully able to comprehend the link between taxation, legal compliance with respect to labor laws, employee needs, the company requirements, and finally, of course, understand some concepts behind flexible benefits planning. While I was preparing the presentation for this webinar, and though we had the topic as emphasis or advantages of having an FBP in your structure, I realized that though implementing an FBP plan is in the right direction, but I also realized that there are a lot of other concepts in and around compensation and structuring that I thought all of you should be aware of. So in the initial part of this webinar, I will be taking a few minutes to explain the concepts one should be aware of while structuring the compensation. So let's start at the beginning and understand first what is salary structuring all about. The greatest asset for most of the companies are its employees, and hence it is very important to have a formal framework to administer the compensation. So this framework is nothing but the salary structuring. Having the framework is very important because it is a means of ensuring that all the employees have a clear career path which aligns to recognition and compensation, so that they stay more focused, more motivated, and thereby increasing the organizational alignment and increasing the return on investment. So the next question is structuring. Okay, yes, but why should I do it? Though most of us know the answers, but most of us also make a mistake of assuming that lowering income tax is the sole reason behind compensation or salary structuring. While no doubt tax planning is an integral part of structuring, the real goal of an effective salary structure is to maintain the balance between something known as internal equity and external equity. So what is internal equity? It is nothing but the fairness criterion that tells you that the employer's pay practices correspond to each job's value in the company. For example, you cannot have a relatively poor performer with lower educational qualifications earn a higher salary than a person with higher degrees or experience or qualification. External equity is nothing but how the employer's compensation levels are compared to the others in the market. So as a fairness measure, the external equity implies that your compensation levels should correspond to the prevailing market rates as determined by the market range and the exact nature of services, etc. So at the end of the day, the real outcome of salary structuring is to maintain balance between the internal equity and the external equity. Only by this will you be able to, in the long term, successfully attract, retain and motivate your greatest assets, which is the employees. So what are the considerations one should have while doing the compensation structuring? If most of us were asked this question, that what should one have in mind while designing a structure, most of us would readily answer that achieving a lower income tax or higher net pay, as the case may be, is a consideration. But we couldn't have been further away from the truth. So people who attended my last webinar on tax planning would remember a saying, don't allow the tax tail to wag the financial planning dog. So tax planning is nothing but a small part, though an integral part of the bigger and overall financial planning. Even from the employer's perspective too, tax lowering for employees should not be the sole criteria guiding the structuring process. So I thought we will study the considerations from the eyes of a HR person as well as a finance person. So from the HR perspective, broadly speaking, the considerations are business and technical. So under the business considerations, the key issues to consider are what are the objectives of the company and to what extent salary will be used, salary or overall compensation will be used to attract and retain the employees so that you achieve your success in the business. Also, you should consider the practices of your nearest competitors and also examine how they structure their and administer their salary programs. All of us know that companies with a dynamic culture, they tend to place less emphasis on fixed pay in favor of variable pay. But organizations with static cultures, they rely more on the fixed pay because they can reasonably predict the business and the employee performance and behaviors. Also, the financial resources available in the company with regard to ability to implement, monitor or administer the compensation is one of the considerations to be kept in mind. The technical considerations are nothing but those characteristics which describe the number of levels, hierarchical levels you have in your company, so that it distinguishes the value of the jobs in the organization. So it could be on, say, the skill level, the responsibility level, the supervisor subordinate relationships, and the different educational qualifications or technical qualifications required. So these are basically the HR perspective considerations. If you go from the finance person's perspective, it is fairly simple. From a finance angle, structuring involves mainly examining the various compliances applicable from the labor laws to the income tax. All this while it was just the labor laws and the income tax, but from financial year 13-14, our finance minister, Mr. Chidambaram, has added one more legislation to be considered by all of you, which is service tax. For people who already didn't know, any compensation paid to directors, which is not in the nature of salary, attracts service tax. So keep this point in mind. So apart from the legal points, the effect of each compensation policy on the employee's take home is also examined by the finance guy. In the appropriate slides further up on this point, we can see how this means something more than just lowering of income taxes. And last but not the least, the sum total of all these result in computing the total cost to company or CTC. So basically these are the four things to be considered from a finance angle while structuring your compensation. Now that we have some idea on what is structuring and what considerations affect the structuring, let us quickly see how we actually go about setting up the same. Actually speaking, the structuring is more governed by the business life cycle of the company. So how a company chooses to pay its employees is most often influenced by where the organization is in the business life cycle. So the life cycles may be startup, growth, maturity, or even decline. So there are different needs and different resources will be available at these various stages, and also they need to be balanced to achieve expected results. If I may just expand this a bit more with an example. So if it is a startup company, it will have limited cash resources, but they will need the key talent to grow the business. So these companies need to invest wisely in their human capital and will want to attract skilled employees. So they may be willing to offer a competitive base salary, maybe with some options of stocks, but with very few or no opportunities for variable pay. But companies with, say, who are in the growth stage will have relatively more cash available and perhaps can afford more competitive salaries, and they will have some cash incentives also so that they can reward and entice new talent. So how to go about structuring is largely driven by the position of your company in the business life cycle. But generally speaking, the organization position, the job type, and the market rates drive the structuring. Market comparisons for a job type and the pay set for positions which are above or below the particular job in the organizational hierarchy are the internal gauges for how a salary for a position should be set. Also, you should remember that a salary structure should be revisited often to ensure competitiveness, and that these are tagged to the market pace in which the pay advances. As your company grows and evolves, it can adjust how it approaches pay according to the business needs, goals, and objectives, and maybe even the monetary resources available at that point of time. So in this slide, which is very clear, I will just take the first point on optimal CTC. So in a recent study by IBM, CEOs identified that human assets are the top assets for sustaining economic value. So for most organizations, rewarding people or paying people is one of the largest investments, accounting to more than 70% of the operating expenses. So given the value of this asset and the cost of maintaining this, the companies seeking a true return on investment in people should develop a deep competency in compensation and rewards, not only to ensure that packages they have created attract, retain and engage the talent, but also to ensure that the company budget is optimized in alignment with the company's business strategy. So an optimal CTC is of paramount importance, and I have a few examples on this particular point further down in my presentation. So what is CTC? As we all know, it is basically the sum total of all the costs, both direct and indirect, company incurs on an employee. While most of us know the various direct factors affecting or resulting in the CTC, we tend to ignore payments like gratuity or superannuation and leave encashment to a large extent from this CTC. And this will lead to a very big hole after many years without you noticing it, and it will be a big amount without you having anticipated for this payout at all. So keep this in mind while you compute the CTC of an employee. It is a different matter altogether that some companies don't show this portion of gratuity, for example, as part of the CTC, either in the employment contract or in the annual hike letters. Their logic being, if an employee really stays with me for 5+ years, let me pay his gratuity, he has really earned it. But that is not the point we are now talking on. Here we are talking of computing the real CTC to be kept in mind while structuring, and it is a must that you should be aware of this cost element if you are talking of total CTC and optimized CTC. So there are no rules to set salary components. and therefore the cost to company structure varies from company to company. However, there are some standard practices considering the income tax impact on components. So why the variations occur are mostly because of the following factors. First is the size and nature of the company or the type of the organization. Small companies usually don't have too many components or reimbursements, so that they avoid the administrative hassles on managing the salary. Similarly, maybe accommodation and medical benefits which are taken for granted in a government job may not be part of the CTC if you are working in a private organization. On the type of company, for example, some CTC components such as uniform allowance may be specific to manufacturing industries. Also, the ways of calculating CTC differ. For instance, company A may pay 50% of the CTC as basic, while company B may take it only at 30%. One bank may include the interest subsidy on loans given to the employees as part of CTC, while others may not. So depending on the type of company, the factors affect the components of the CTC and the way it is computed. Also, the location of work, whether you are posted in a metro or non-metro city, may influence certain components, chiefly depending upon the cost of living in different cities as well as the working hours. You may even get a special allowance in locations where working conditions are not very conducive. Also, certain components like house rent allowance and the perquisite value of employer-owned rent-free accommodation may vary based on the location of the employee. Now for some real actionable items on CTC optimization, I have tried to list a few points in this direction. On the PF, all of us know that there is an option to contribute PF either on full basic plus DA or on a restricted rupees 6,500 basic plus DA. While we are on this point, all of you should be aware that this limit of rupees 6,500 is likely to be hiked to rupees 15,000 with effect from 1st April 2014. The PF Trust Board, which manages the PF from the government's side, has already agreed to hike the limit and has proposed the same to the Finance Ministry, and in February even the Finance Ministry has agreed for the proposal. So I think only a gazette notification is pending. So the hike is imminent and it remains to be seen what will be the effective date. But the 6,500 will soon become rupees 15,000. But in my example and workings, I have taken the current limit of rupees 6,500. I will explain how PF and also the other points in this slide being VPF, Gratuity and ESI can be tweaked or used to derive different CTCs. VPF is something we all tend to miss. I have covered that point also in the subsequent slides. So let us take an example of an employee getting rupees 4 lakhs per annum as his basic salary, and one more 4 lakh, all his other salary components included. So the total salary of the employee is rupees 8 lakhs in both options. The first option being PF is paid on the actual basic, and in option 2 it is paid only on the restricted rupees 6,500. So 4 lakh into 12% is 48,000 for the year, which is the employer's contribution of PF. But in option 2 it is only rupees 9,360 because it is on a restricted rupees 6,500. So you can see that the employer contribution of PF differs by 38,000 plus rupees in option A and option B, though the total salary for the employee is the same. So correspondingly, the CTC of the employee in the two cases, one is 8,48,000 and the other it is just 8,09,000. This also has a bearing on the take home of the employee, the difference being as high as 77,280 because the employee's contribution is also to be knocked off in the take home calculations. So a small policy change that you pay PF only on the restricted amount can result in an employee getting the same salary as same gross salaries. The CTC and the take home can be vastly different. Now coming to VPF, all of us know that an employee can contribute up to 100% of his basic as PF plus VPF, and voluntary PF has the same benefits as the normal PF in terms of the interest earned, loan facilities available, and the income tax treatment. But most of us would not be knowing that all VPF contributions attract an admin charge on the employer at 1.1%. So if an employee wishes to contribute rupees 2,50,000 as VPF in the year, the employer will be paying close to 23,000 rupees as the admin charge. So this is calculated by getting the VPF basic. So VPF basic is 2,50,000 divided by 12%. 12% being the contribution rate specified. So that into 1.1% results in 22,917. So this is something which most of us tend to miss in including this as part of the cost to company, because this is a real outflow the company has to pay the PF department whenever it agrees to manage VPF on behalf of the employees. When it comes to gratuity and leave encashment also, we tend to ignore either wantingly or unwantingly or unknowingly. So all of us know that any person completing 5 years of continuous employment is eligible for gratuity. So in my example, I have taken an employee who has worked for 6 years, earning rupees 50,000 as basic at the time of leaving the company. The gratuity payable is 1.73 lakhs. And this amount will slowly build month over month over the 60 months from the date of joining of this employee, and you will never realize that there is such a big amount which has got added up. One fine day when the employee wants to leave, you are left with a big 1.73 outflow. So always consider 5% of basic. This 5% is arrived by taking the gratuity payable, which is 1.73 in this case, divided by basic, which is 50,000, divided by months of service in my example, which is 6 into 12, 72 months. So in all the cases, if you consider 5% of basic as the cost of gratuity contribution in the CTC workings from day one, you are then really computing the actual CTC. It is a different matter, as I have already repeated, whether you want to show it or not, whether you think the employee has earned the gratuity because he has really stayed with your company. That apart, calculating the CTC, you should definitely take 5% of basic right from day one. Now, let me see if the ESI can also be used to manage the CTC. So we all know that the ESI limit is rupees 15,000 of gross wages, and one more bad news is, just like the increase in PF limits, the ESI limit will most probably be hiked from the 1st of April 2014. So we are just 10-12 days away from that, to rupees 25,000. Yes, you have heard me right. From 15,000 it will be hiked to rupees 25,000. So all the employees who earn gross salary or wages up to rupees 25,000 will now be covered under ESI, and so the contribution on ESI will be on a max of rupees 25,000 or actual gross, whichever is lower, for all the eligible employees. So this is a big hit for all, especially for those who are liable for ESI coverage but actually don't end up using the ESI hospital benefits. So in my example, I have just taken the current limit of rupees 15,000. So most of us also know that ESI is payable even on an employee who earns more than 15,000, which is the threshold limit, if his or her salary was below 15,000 for any month in the 2 6-month periods of April to September and October to March. So if an employee has say 14,000 as salary in 1 month, he needs to pay ESI on that amount or 15,000, whichever is lower, till the September is over. Anyway, I have explained this in the next slide. I have taken an example where a person joins the company on 1st of April and he has a probation period of 3 months. Let us assume that the probationary salary is rupees 14,000 per month, and after confirmation the person will be getting rupees 20,000 and the employee is getting confirmed after 3 months. So in the first scenario, what I have computed is the April to June, which is the probationary period salary, which is 42,000, and the ESI employer's contribution works out to 1,995 rupees. And because the employee completes the probation and then moves on to become a confirmed employee and hence earns 20,000 as salary from July, and so he gets 60,000 rupees as salary for 3 months, he still needs to contribute ESI because in this period of April to September, he has earned or he was liable for coverage in a single month. So he still needs to contribute ESI on 15K. So that comes up to rupees 2,138. So the total salary taken by this person from April to September is 1,02,000, which is 14,000 into 3 plus 20,000 into 3. In the other example, option B, what I have done is, instead of paying 14,000 as salary for 3 months and then 20,000 for the next periods, I have assumed that instead of 14 you pay 15,100 as salary for 3 months, and then for the next 3 months you pay him instead of 20,000 1,100 rupees less, which is 18,900 per month. As you can see, the total salary outflow for the company is the same 1,02,000 in both the scenarios. So there is no difference in the cash outflow for the company, but there is a 4,133 rupees CTC difference just because there was a ESI applicable in option A. Also the net pay for the employee, so apart from the 4.75, the 1.75 of the employee contribution results in the net pay being significantly lower for this person in option A. So in all cases where, if I go back to the previous slide, so from a pure ESI angle, it makes sense to have increment dates effective as 1st of April or 1st of October, or even say if you have a probation period, etc., or a confirmation or a hike happening, it will be good that if you keep this example in mind, and accordingly if a person is really close to the ESI threshold limit, then you increase and decrease the salaries accordingly to get the optimum CTC. So the second point in the considerations for CTC structuring was the employee needs. So it is very important to keep the employee needs while structuring the compensation. Best thing is to put yourself in the shoes of an employee, and again, please don't assume that reduction in taxes is the only criteria. So for example, if you are young, single and just starting out in life, a new job, you may want to maximize the portion of your salary that is paid in the form of cash, and to minimize the amount which may, for example, go to a retirement savings or a medical insurance. Because you are likely to be healthy and thus require a less expensive medical scheme. You may also have many years of economic life ahead of you in which you can save towards your retirement. So you can afford to peg your contributions to all the insurance schemes at a lower rate. And at this stage, you're also unlikely to need a large amount of life cover. If your employer offers you a choice of the level at which you can insure your life, so for example, even if it is 1 time or 3 times or even 10 times of your annual salary, you're likely to choose only the lowest level. But however, if you're getting older, you're earning more, and you're happily married with a family, you will want to maximize the amount of life cover. So for example, in this case, you will be choosing 10 times of your annual salary to be set apart for your insurance. And you will also want a comprehensive medical insurance coverage so that you can cover each of your family members. So a single straight tax angle will not work always in all the stages of your life or employment, though tax optimization is very much a necessity. As earlier said, tax planning is only part of the bigger financial planning and cannot dictate the financial matters. So if I may explain with an example, you should not buy an insurance plan because you think you can save some tax under section 80C. Here, based on the financial plan, which is of paramount importance, you should buy an insurance cover even if you have exhausted your 80C limits, or you should not buy any insurance plan even if you have some limits unutilized in your section 80C, because buying an insurance you should always not have the tax in mind but the overall financial plan in mind. From telling all through that taxation is not the sole criterion for salary structuring, now let us give some importance to taxation. So from here on, my balance slide deck will mostly talk from this angle, except for the last two slides which are on the labor law compliance. So just to set the context, let us brush up some concepts, basic concepts. The first is the types of various salary components as you can see in this slide: earnings, deductions, reimbursements, and the statutory components. One other way of presenting the types of pay components is taxable, partly taxable, and completely exempt. So this last, completely exempt, or the reimbursement, which you can see here in the last picture, that is going to play the key role going forward, and that is how we will be analyzing what is FBP and how to implement a FBP in your company. So before we move to FBP, a very quick glance. All of us will be very well aware of all these basics as to how basic is taxed, how HRA is partly taxed, and some things like conveyance allowance and medical are completely exempt. Provided for medical you provide the bills up to rupees 15,000. So I'll quickly jump ahead because we will need to now tackle FBP. So coming on to the topic of FBP, so let us understand what is a flexible benefits plan or a basket of allowance plan, as many companies call it. In the pre-internet days, it was rare for employees to have sharp insight into the typical pay for a given job. But with the internet boom, now employees and job seekers have more access to data and approach the employer-employee value exchange as more informed customers, and they believe that they deserve fair and competitive rewards. Hence, each day the job of the HR or the finance head of the company is all the more challenging because he or she needs to ensure that the compensation packages are not only competitive but they are also innovative and flexible. And in this context, FBP plays a very crucial role in giving the employees flexibility, no doubt within certain boundaries, to pick and choose how they get paid. So FBP is all about allowing employees to structure their salary package in line with their needs. From a pure HR perspective, if your company packages salary correctly, it should give employees the personal flexibility that they can exercise annually or in response to some events. Also, from an employee perspective, if you think, won't you want to have the ability to choose between better benefits and more take-home pay? So if as an employer, you're offering all this, your employees should get the desired flexibility in choosing their compensation packages. Also, one important point to be noted on FBP is it doesn't mean that all the components forming part of the flexible plan result in some tax advantage to the employee. Though the tax advantage will be a chief consideration in many cases, but that is not the rule that all FBP components result in some tax benefit. Many companies have just a fixed basic and all the rest of the components including items like HRA, medical and conveyance are under the flexible plan, and the employee is free to choose what he wants under certain upper limits. In many other companies, FBP components are usually those components which are paid out as reimbursements and hence are fully exempt from taxation. A typical flexible benefit plan would look like this. Say there are two fixed components, basic and say medical allowance, and there are six flexible components: HRA, mobile, data card reimbursement, vehicle maintenance, fuel, books and periodicals. So in a typical scenario, an employee will be free to choose which of these six he will want. He may also choose all the six, but under a certain prefixed boundary. So if the total kitty available is rupees 50,000, the employee can choose to allocate this amongst these six components. Any unallocated amount is treated as special allowance automatically and will be hence fully taxed. The common question people have around FBP is, how do you pay an employee, say something, say a fuel reimbursement, and claim taxation from, claim the exemption from taxation? So I have tried to put a draft FBP rule of a company which is into the ERP segment, a software company. So here the rule states that, so FBP is being introduced because employees in this company are required to work late so that they complete the projects on time, or they are required to stay back and take conference calls because their clients are in different time zones, and employees are usually required to come on notified weekends and holidays maybe. They may need to work from home to take calls, and to be successful in the company and for the success of the company as a whole, all the employees need to constantly update themselves with the latest happenings in the ERP world. So if this is the rule you have set or the context you have set for the FBP, part of the compensation has been set apart towards reimbursement of fuel and vehicle maintenance, maybe telephone and broadband, and books of professional interest. So based on the rule and based on the bills submitted by an employee, the amount paid towards fuel is only a reimbursement towards discharge of official duties, and so this is taken as a pure reimbursement and does not form part of the salary. And this is also accounted as fuel expenses in the books of the company and not as salary paid. Hence, there is no question of taxing this fuel reimbursement. So while the previous slide spoke about the overall FBP rule and the context, this slide shows the specific rules on books and fuel, which are part of the overall FBP plan. So these rules are to ensure that the payments made to employees are in the nature of official expenses and not personal in nature. Based on these lines, you can draft suitable rules for each of the FBP components in your company, so that all the expenses which the employee claims are official in nature, with the overall purpose being either improvement in the employee's skills, morale of the employee, reimbursement of expenses incurred in the nature of in the discharge of official duties. So let's quickly see how an FBP plan is implemented. Step 1 is to identify some components as fixed and some as part of the flexible plan. Then you should be creating different bands of employees, groups of employees. The criterion here can be CTC range or people in a certain designation, above a designation or below a designation. The idea of creating these bands is to ensure that the upper limits fixed are not too high or too low for that band for that specific expense head. So for example, it doesn't make any sense to make driver's salary as a reimbursement component available to people drawing say 3 lakhs of salary per annum. At this level, the employee is likely to own only a two-wheeler, and having the driver for a two-wheeler will not stand the test in the eyes of your auditor or the income tax officer. So create the bands and then move on to creating the upper and the lower limits as applicable for each of the components you have identified to be part of the flexible plan. So in this screenshot, you can see that for a FBP component called vehicle reimbursement, for the CTC band which is up to rupees 1.5 lakhs, this is not available for an employee to choose, meaning all the employees in this band of up to rupees 1.5 lakhs salary will not be able to choose this component. And for the next band of 1.5 to 3 lakhs, 10% of their basic is available as the upper limit for the employees to choose, and so on. 3 lakhs to 15 lakhs, it is a flat of 15 per month, and for the next band, it is rupees 25,000 per month. So the next step in implementing the FBP after you have created the band and the upper limits is to fix the other rules for the components. So all the rules generally followed by the companies are listed in this slide. Some captions are self-explanatory and I will not explain in detail about those. Let's take allow carry forward of low excess bills and analyze it so that you understand the principle behind this. Say you have a component called telephone reimbursement in your FBP. So here you will need to specify what happens to this component in different scenarios. So for example, let's say the limit fixed is rupees 2,500 per month, and one employee has chosen to avail rupees 2,000 out of this. Now if an employee submits a claim of rupees 1,500 this month and rupees 2,500 next month, will that be allowed or not is something you need to set as a rule. Similarly, if an employee submits a bill for rupees 3,000 and you pay only rupees 2,000, which is his eligible amount, what happens to the balance bill of rupees 1,000? Can the employee carry forward this to the next month is a rule you need to set. Similarly, if it is a component like leave travel allowance, you will normally need to allow the employee to claim the full amount in one shot after he has completed the travel, irrespective of the number of months he has worked or to be worked in the financial year. Again, items like gift coupons also need to be usually claimed in a single shot. Some items like say fuel reimbursement may have a rule that an employee choosing this component cannot choose some other component, say conveyance allowance, and so on. So the rules what you see in this slide are normally what companies use to manage and implement the FBP in their companies. So it is not necessary that you need to have a tool, but even an Excel spreadsheet can help you achieve all these controls. But all said and done, a payroll application with the capabilities of handling and helping your FBP compliances will be always better. So the next thing you need to know on how FBP works is then letting employees choose their desired components. Based on the already discussed rules, you should come out with an FBP policy and enable access to this document for all the employees in your company. Based on the rules, CTC designation or the applicable band, employees now need to choose what components they want in their package. For all the reimbursable components, the employees will choose based on the ability to provide valid bills and other rules like eligibility and bills carry forward, etc. So in this slide, you can see how a tool to manage FBP can be used so that the employees get an option to declare their FBP components. That is, first of all, choose which components they want and the amounts against each component. So in this case, you can see that excuse me, the employee has not chosen anything against books and periodicals, but has chosen vehicle reimbursement of rupees 1000 per month. So this activity of declaration by the employee is usually done at the beginning of the financial year, and usually no changes are permitted. But bigger companies, based on availability of resources and ability to track changes in the declarations, can even open this declaration window each month. An integral part of FBP implementation and management is to give the ability for employees to submit bills month over month for the chosen components, and also to give them ability to track their overall position of bills submitted, the amount paid out, and if there is any carry forward of eligibility or bills. So this slide shows how a tool to manage FBP would help employees in managing all this. So what are the usual FBP components? So there is no fixed rule or act which governs what should be part of the FBP. The rule you need to follow in choosing and fixing rules are based on the ability to prove that these expenses were incurred by the employee to further his professional skills and discharge his duties better. A very important point to remember in FBP is never pay any component as a fixed sum month over month without collection of bills, because the very basic premise behind FBP is that this is not part of the normal salary, and as per the Income Tax Act, any sum paid as a fixed sum each month will take the color of an allowance, and as per section 15 of the Act, it will become taxable. So you should always ensure that employees choose a component, submit bills, and only then are paid out the amount for which the bills are submitted. So one more question that may arise in the minds of a first time FBP implementer is, under which section should I give exemption to the FBP components? So the answer is very simple. There is no question of giving an exemption under any section under the Income Tax Act, because in the first place this is not treated as a taxable item itself, but rather a reimbursement given to the employee. But as a matter of abundant caution, all the users are strongly advised to take the opinion of your auditors and implement FBP based on their confirmation and blessings, because they will be the people representing you in front of the income tax authorities and presenting your case. The explanations and ideas given in this webinar are more in the nature of giving the different ways FBP components are handled, its implementation. Whatever rules we have seen are generally followed by all the companies today, including the big companies. But this should not be construed as advice given in your specific case, because unfortunately income tax is full of written laws, unwritten laws, lot of gray areas, and in some cases even invisible areas. So you should always consult your tax auditor who understands your company the best while implementing the FBP. The last thing you should be aware of how FBP is handled by different companies is basically on how flexible is your flexible plan. So while the traditional structure in the pie chart here, the first chart, does not have any flexibility because it has all components as fixed. The other two charts show two options. One is have some fixed components and some as part of flexible plan. And the last chart shows all as flexible except the basic. But in some companies even basic is flexible. So all the components including basic are flexible and are configurable. So which plan you implement is really dependent on the resources available at your disposal to implement and manage and even administer the FBP, all the people available, processes you have set, policies in your company, and most importantly a good robust flexible tool which is both employer and employee facing to manage FBP. Last but not the least, salary structuring has a big relationship with the labor laws. India is a land of many acts and laws, and unfortunately still evolving in terms of having maturity on compliance and regulation. It is a tough job to be first of all aware of the various labor acts which apply to one's business entity and then to comply with all of them. How many of us will comply or even are aware of the act called Employment Exchanges Compulsory Notification of Vacancies Act 1959? While some acts listed in these two slides are directly affecting your compensation, mainly the PF at 12%, profession tax, ESI, or the labor welfare contribution, or even the Minimum Wages Act, which tells how much of basic at a minimum is to be paid to workers, and say Maternity Benefits Act, which mandates paying of salaries for a particular period of time, or even Bonus Act, which specifies how much of profits or bonus is to be paid to eligible employees, etc. There are some laws listed in these two slides which really don't affect the way you structure your compensation or pay your employees. So for example, the Employment Exchanges Act, the Contract Labor Abolition Act, the Industrial Standing Orders Act, all these only mandate certain disclosures. They tell that certain forms are to be filed or filled and kept, and they have rules on how to manage employees' work standards, leave and absence, welfare, etc. As HR and finance professionals running companies or even entrepreneurs running companies, all of us should be well aware that there are many laws which are applicable to one's company, and they should be aware that these affect the compensation and the compensation planning. Even if you have outsourced all this to a consultant, you will be well advised to have basic knowledge on all these acts so that you don't become a victim of the law is an ass and sometimes it kicks. So with this, I have reached the end of my slide deck on compensation structuring and FBP. Hope this webinar helped you to take at least one step ahead in your overall understanding of compensation structuring and to think beyond tax optimization. A measured and mindful approach to employee compensation ensures that you have a very solid framework in which you define work, help employees to find meaning in what they do, and also wisely manage the company's most critical investment, which is the employees. So thank you all of you for patient hearing. I will now be taking questions put up by all the participants. I will be reading out the questions and trying to answer them. So if you have any questions and you haven't typed them out, please use the chat box at the right of your screen and I will be answering them soon. Mr. Gautami Ji, I think Miss Gautami Ji has asked a question. Can you tell us what is the meaning of restricted basic and how to calculate that? So Gautami, PF is paid at 12% on either the actual basic plus DA drawn by the employee or a restricted amount which is as of today rupees 6,500. So if an employee is getting rupees 15,000 as monthly salary and rupees 10,000 is his basic, in option 1 you will be contributing 12% on rupees 10,000, which is PF on the full basic, or in option 2 you are free to contribute 12% on rupees 6,500. Rupees 6,500 is the mandated minimum amount of PF. So this is the restricted basic. So even if the employee is earning something beyond rupees 6,500 as basic, you pay PF only on 6,500. How is gratuity calculated in the example? Gratuity, the formula is like this. You take the last drawn basic, multiply that by 15 by 26. 15 by 26 is nothing but calculating half month's salary. 26 is the denominator, so they have excluded 4 Sundays in a month. So instead of 15 by 30, which is half month, they have taken 15 by 26. That into number of years a person has served in the company, that will give you the gratuity payable. So I think in my example I had assumed 50,000 as basic. 50,000 into 15 by 26 into 6, which is the number of years, will give you 1.73 lakhs. There is one more question on, can you explain about the business considerations while structuring your salary. I will come to that question shortly. Mr. Dilip Singhal has a question: should we apply professional tax while reimbursing driver's salary? So this is a very good question and a tricky question as well. So there are two ways of handling the driver's salary. You should also be aware that as per the PF and ESI Acts, there is a concept called principal employer. So if you are employing a security services company who provides security guards in your company, as a principal employer, you are liable to pay the PF or ensure that the security agency you have hired pays the PF, and only upon confirmation you pay the bill of the security agency. So it is wise to keep the drivers out of the ambit of all PT, PF and ESI. Otherwise, you will be falling in the trap of all these compliances. So here in this case, the logic is, I am paying my employee whatever it takes for him to effectively discharge his duties, and his duties include working late hours, coming early, working on weekends, working till midnight to take calls, and hence he has, as part of his convenience, chosen to keep a driver, and that is an expense the employee has incurred in the discharge of his duties. So it is paid directly to the employee, not to the account of the driver of the employee. So if you pay anything to the driver, then you automatically become the principal employer and all the PT, PF, ESI compliances apply. Would direct taxes code have an impact on FBP? Is a question asked by Mr. Amol Nakwe. Unfortunately, there is no clear yes or no answer. Even as of now, this FBP is practiced by all the big companies in India, though there is no specific section governing something called FBP. FBP is a term created by the HR community, not by the legislation. Some years back, there was a fringe benefit tax in vogue, which was again taken off, and because it was taken off, many tax experts interpret that as the income tax department giving indirect blessings to this concept called FBP. But the real challenge will be to prove that whatever reimbursements you are making to the employee are not personal in nature, but are only towards effective discharge of the official duties of the employee. Mr. Prashant Meka asks a question on any advice on incentive structures. From a compensation structuring perspective with respect to income tax or the labor law, there is no specific point you need to be aware of, because all of them are from the income tax perspective, any incentive you pay to the employee is fully taxable, and so there is no way out from the income tax TDS on this incentive. Again, if it is incentive paid to an employee covered under ESI scheme, then even that will attract ESI. But PF is not applicable on any incentive paid. So how to have an incentive structure in the first place, if that is a question, then it really depends on the nature of industry you are in. There are proven incentive structures in the market now based on which business you are. If you are in the FMCG space, then it is different. If you are in a BPO, it is different. If you are in the delivery team of IT company, then it is different. So really depends on the nature of business and the end goals you want your employees to achieve. The next question is by Suchi Thakur. The question is, if the employee's salary increases and he is no more coverable under ESI, will he be refunded his ESI contribution from the government like PF? I am afraid to tell no. As far as our experience goes in the last 10-15 years in this field, I have not heard of a case where the ESI department has refunded a contribution which is paid by oversight. Again, there is a question by Sachin. I have a few queries on how to implement FBP. So Sachin, please go ahead and type your questions. I can take the same. Gautami has a question. Will implementing FBP in a company increase the total cost the company incurred in a year than before implementing FBP? Very, very practical, well thought out question, but the answer is very simple. No. Because of implementing FBP, the real CTC of an employee is either not going to go up or come down. But to administer FBP, you should have a mechanism in place which, for example, if you have say 50 employees in your company, you should have a mechanism of ability to collect bills from these 50 employees month over month, go through them, approve some, reject some, answer employee questions. So it may mean that you employ one more junior assistant, accountant, or you should go for a robust tool which helps you to manage all this. So there may be definitely an increase in terms of employing or subscribing to a tool, but really when it comes to employees CTC, there is absolutely no difference between with FBP and without FBP as far as the CTC goes. So if you have really administered effective FBP, the employee morale will definitely go up because most of them will now be taking a bigger take home. Shravan Kumar. No Prashant. So Mr. Prashant Meka asks, who would be the right person to draft salary structures? A CA or a CS or auditor or lawyer? It really depends on the size of your company because none of them will be competent to give you a wholesome picture of the salary structuring. As we just saw in our presentation, there are many considerations beyond taxation which you should consider while implementing a structure. In your list, the HR is completely missing. So it is really a joint effort between the HR of the company, or if you don't have an HR yourself, please take some outside help as a one-time effort in engaging a company who will do a study of your nature of business, the position of your company in the business life cycle, what is the nature of employees you employ, what are the needs of the employees based on a lot of criteria which we discussed. So that is one part. The second part will be compliance with income tax, labor law and CTC, which your CA will be able to do. So you should ideally consult, or this should be a joint effort between your auditor and your HR or a outsourced HR agency. Sachin Munot asks, how about TDS deductions? Should it be done in the last month of financial year? No. Unfortunately, many of the companies follow this, but as per the circular issued by the income tax, I don't remember the circular number offhand, but almost each year the department comes out with a circular given to the employers based on which they need to do the TDS. So as per this circular and as per the income tax provisions and the spirit behind the TDS should be done equally as far as possible over all the 12 months in the financial year. So the first step is to compute the likely total income of the employee for the year, and on that amount compute the likely total tax liability and divide that by 12, and that divided by 12 amount should be the TDS you should deduct each month. Lalit Balasubramanian has an interesting question. Regarding reimbursement, can we pay the amount on a monthly basis and collect the bills at the end of the year? So as I already mentioned, though many companies have this practice, it is strictly not advised, simply because Section 17 and Section 15 of the Income Tax Act tell that any amount paid as a fixed sum each month, it takes the color of an allowance. So even for that matter, the medical reimbursement of rupees 15,000 paid, first of all, should not be termed as medical allowance, because any allowance whatsoever is completely taxable. So it should be ideally termed as medical reimbursement, and even that 15,000 which is specified by the Act should not be paid month over month, that is 1,250 fixed month over month, but rather paid as and when the employees submit the bills, or paid in one shot in the year end based on the bills submitted. Whatever is not supported by bills is taxed. So even in the FBP scenario, please ensure that you collect bills and then pay the amount. Though this results in some extra administrative effort in terms of collection and monitoring the bills, this is a worthwhile effort if you really want to be answering the questions of the income tax officer, that this is not salary but reimbursement of expenses towards discharge of official duties. We are paying medical allowances in FBP. We should consider this for tax computation in the gross income or not? Yes. As this is a question asked by Manoj Pandey, as I already told, components in the FBP need not be always in the nature of a reimbursement. Even your HRA, even your LTA, even conveyance allowance or medical allowance or medical reimbursement, to be very specific, can be part of FBP, and for all these components which the Income Tax Act specifically tells out these are the limits or the rules to be followed, you should definitely consider them as part of the tax computation and then give an exemption under Section 10. So if it is medical or even HRA, then section 10(13) subsection subclause A will be the section which governs this. So you should definitely show the total HRA as part of the gross and then reduce the amount which is allowed by section 10(13)A. Shravan Kumar asks one more question. If under an FBP scheme an employee provides personal bills, how can we reimburse? If it is personal in nature, then it is always taxable. But the idea here is to tell these are not personal in nature. So for example, if you take the home broadband reimbursement, you can argue that this is personal in nature because my employee surfs the web or his children see some movies on the internet. But the other argument can be, I provide this facility for my employee so that he can work from home whenever required, take calls whenever required, and complete all the deadlines given to him even while working from home. Working from home is possible only if I provide him a home internet connection, and hence I am reimbursing it. So it is really not a personal expense in that sense, and hence you can reimburse this, and this will be allowed as a expenditure. Rekha Pandey's question. Rekha, you will need to ask this question offline. I can take questions concerning the general audience here. So you can please write to me. We can take it forward. So what are the admin charges in ESIC? No, admin charges are there only in PF Ritika. This 4.75% and 1.75% employer and employee contribution is on the ESI. Can we show Sodexo vouchers and coupons in Form 16 as an exemption? Asked by Shravan Kumar. Yes, the answer is yes. Is there any problem if we reimburse employee bills in the form of FBP by booking company expenditure? The answer is no. There will be no problems. All these are not salary expenses, but are expenses like fuel, telephone, conveyance, maintenance, etc. And you are right in accounting them as company expenses. One interesting question, can I opt for a restricted PF contribution in mid of the year? Is it possible? The question is asked by Vishal Kumar. The answer is yes, but you should follow certain procedures in doing this, Vishal. The procedure is like this. First of all, you should pass a resolution in the board meeting stating that you wish to now change your method of PF contribution. You should get the approval of the change of this scheme from a majority of your employees. So they should sign on a document which tells they are in agreement for this change, and then you should make out a letter to your PF officer stating of your wish, and submit the board declaration and the employee permission letter, and do some follow-up at the department, get it sanctioned, and then you can definitely change the method of PF contribution in the mid of the year. Ashok Doddi asks a question. I think we are running out of time, but I still have a lot of questions. So people who still have some time can stay on. Otherwise, a great thanks for all of the participants. I will keep answering the questions for the next 10 minutes. So what happens if an employee goes beyond rupees 6,500 and they give a confirmation that they don't want to pay PF? Being an employer, what should we do? Again, the strict interpretation of the PF rules here is any person getting basic beyond rupees 6,500 can opt out of PF only if the following two conditions or both the two conditions are satisfied. One is she should not have been a member of the PF any time before. So that will happen only if you are a first time employee, and if from day one you have a salary above rupees 6,500 and your earlier employers have never deducted PF for you. So the two conditions are you should definitely be earning more than 6,500, and the second important condition is at any point of time in the past that employee should not have contributed to PF at all. Only such a person is eligible to opt out of PF. Otherwise, as an employer, you are liable for contributing your 12% plus employees 12% if the PF department conducts an audit. Harish has a question. If an employee completes 4.5 or 4.6 years, that is 4 years and 5 months or 6 months, will that be considered as 5 years for gratuity? The answer is no. For a person to be eligible to be paid gratuity, he definitely has to complete 5 years of continuous service. This rounding of the months to the next full year is only after a person has completed 5 years and used only to compute the gratuity payable. So to examine if a person is really eligible for gratuity or not, he has to complete 5 continuous years, and after that any months are rounded up, any months after 6 are rounded up to the next year. But for gratuity eligibility purposes, minimum of 5 years, even if it is 4 years and 360 days, the answer is no for gratuity. Many people have left after putting up the questions, so I will ignore them for the time being. Implementing FBP increases or decreases the company's total payout in a month is a question asked by Gautami. Gautami, the answer is in most of the cases the total payout is going to be reduced. Again, it is only the total payout, but what is payable will remain the same. If you have FBP or if you don't have FBP, the amount payable to the employee will be the same. But in most of the cases, the employee will be giving bills to a lower extent and then making it up in the next month or in the next months. So in that case, what will happen is for a particular month, the payout is lower because some employees will not have submitted the bills. Manoj Pandey's question is, we should not pay a fixed amount every month to an employee as FBP, but suppose if an employee has applied for a fixed amount of rupees 12,000 yearly and he is submitting every month bills above rupees 1,000, then are we bound to pay max rupees 1000 every month to the employee? It is also fixed payment to the employee, so that yeah, Manoj, my idea of telling that you should not pay a fixed amount was more from a fixed amount without underlying supporting bills. When can you pay a fixed amount? When there is no bill. But even if it is a fixed amount supported by a bill, which is a very rare case, for example, if you take telephone reimbursement. So say my limit is rupees 3000 a month. I will always have bills either less than 3 or more than 3. If it is more than 3, I can continuously pay a fixed amount of 3000. But the fact is, the bill is not a constant 3000 each month. It varies. And that is one of the reasons why we can argue that this is not a fixed amount, irrespective of whether the employee has incurred an expense or not, which is paid out. In CTC norms, is employer's PF contribution to be considered as perks? By Vishal Kumar. Vishal, no, PF contribution of the employer is part of the CTC, but not part of the perk. But if the employer contributes more than 12%, yes, then it becomes a perquisite. Sachin Munoth has a question. We have a different salary structure wherein we pay 15% of monthly salary on quarterly basis. So how should it be mentioned in the salary slip? Salary slip, you can call it any fancy name you want, Sachin. It can be retained compensation, or whatever is the reason why you withhold 15%, that can be the name of the payout, and that is anyway, for your information, fully taxed. Is a company private limited required to register with Shops and Establishments Act? By Vishal Kumar. Yes, Vishal, you definitely need to register under Shops and Establishment Act. You need to pay a license fee, which is usually renewable every 5 years. Based on the head count of your company, at the time of registration, you need to pay a fee to the Shops and Establishment department. And you should also maintain certain registers in terms of attendance and the salaries, and submit annual returns every December to the department. I still have more than 25-30 questions. For all those people whose questions were unanswered, please write to info@paybooks.in. We have already overshot the session by 15 minutes. I will be glad to take the questions and provide the answers. So please feel free to write to info@paybooks.in with your specific questions. Be as descriptive as possible in the question, so that in one shot I can give you a convincing reply. I am still having a lot of questions getting written, but sorry, since we have exceeded the allotted time, I will not be able to answer them in this session. Thanks all of you for a patient hearing and for the great response all of you have shown. We hope to continue the webinar sessions on topics which are of interest to all of you. So at the end of this, you will have a small poll. Please take 2 minutes of your time in answering them so that we can take topics which are of utmost use to all of you. And thanks once again. A great evening to all of you. Bye.